And it's important to understand there's a difference between a financial crisis and a recession. They're both bad, but they're two different things. 1998 was a severe financial crisis, but there was no recession. I mean, the NASDAQ hit an all-time high on January 1st, 2000. It went on for another year and a half, and there was no recession. 1990, 91 was an example of a recession, but no financial crisis. Some losses in commercial real estate, but there was no financial panic. 2008 was both. 2020 was a severe economic contraction.
This is Jim Rickards, a former lawyer and investment banker who is now an economist, media commentator, and best-selling author on finance matters and precious metals. He has worked for both the U.S. government and the private sector. It's almost impossible to avoid hearing about the next potential financial crisis or recession. From Wall Street to Main Street, everyone is talking about impending doom and gloom. But what exactly is the difference between a financial crisis and a recession? The answer may surprise you. A recession is commonly understood to be a period of time when the economy contracts. But what exactly is a financial crisis? And what's the difference between a recession and a financial crisis? To answer that, we need to take a closer look at what economists believe makes up these two conditions. When we dig deeper, it's easy to see how these phrases are related but have some key differences. Welcome to Savvy Economists. In this video episode, we will discuss Jim Rickards' opinion explaining the difference between a financial crisis and a recession. Don't forget to please watch, like, and share this video if you enjoy it. Also, leave your comments and thoughts below, and don't forget to subscribe to the channel for more related content similar to this. Casual observations about the two terms financial crisis and recession might lead one to believe that they are synonyms for each other. However, fluctuating economic conditions warrant an in-depth look into what it means when somebody calls an event a financial crisis or a recession. Economist Julius Sherskin came up with some specific rules to define what a recession was in 1974. This definition of his eventually grew over the years to become a common standard. So, how did he describe it? Here is it. Sherskin considered 2 consecutive quarters of declining GDP. Then he stated that a healthy economy expands over time, but when there is an occurrence of 2 quarters in a row of contracting output, then there is surely a serious underlying problem going on. However, the National Bureau of Economic Research, NBER, came up with the definition that a recession occurs when there is a significant economic activity decline in a nation that spreads across its economy and can last for several months to come. Okay, so yeah, we've been talking about the recession. How about a financial crisis? A March post by CFI defined a financial crisis as a situation in which important financial assets such as real estate, oil, or stocks abruptly lose a substantial amount of their nominal value. The two conditions are related in that both come with negative economic impacts. And while they have some similarities, there are also a few key differences.
Technically, 2 quarters. Technically, it was 2 quarters, but it was really 2 months, March and April 2020. But March happened to be in the first quarter, April was in the second quarter, so it took both quarters down. But that was really concentrated in about 2 months, and then it kind of came roaring back. But I call it a severe recession, contraction. But there was no financial panic in 2020. The stock market went down 30%, but it doubled from there. So these things can come together, and we're almost certainly in a recession now. The recession will get worse. So that's not priced into the markets, but you don't even have to guess. That's here. It's going to get worse. The question is, are we in for a financial panic? That's kind of what you were referring to, Brian. And the evidence is yes. The evidence is right in front of your face if you know where to look, but most people don't. It's a little bit technical. I can explain it in plain English, but the signs are there.
Jim Rickards believes that we are almost certainly in for a recession now and not a financial crisis, and it's going to get worse. We all can't take Jim's predictions with levity because he also predicted the biggest financial crisis in American history. While a recession is a period of negative economic growth, a financial crisis is a much more severe economic downturn that can have a major impact on the financial markets and the economy. A financial crisis can cause a recession, but a recession does not necessarily mean that a financial crisis is occurring. The real economic crisis begins when a financial crisis and recession are combined, as was the case for the fateful years of 2007 to 2009.
Well, I can give you more than a hint. Like I said, these things, they're often presented technically because some expert wants to seem smart or whatever, but you can do it in plain English. So basically what we're talking about, the warning signal, and it's a bright red flashing light, is an inverted yield curve. So what does a normal yield curve look like? So the x-axis is time, and the y-axis is interest rate. So, and treasury market's a good example, but there are other markets. I'll get to one in a second. So what are the maturities of treasury? Well, it's 30-day bill, 60-day bill, 90-day bill, 1-year bill, or 360-day bill, 2-year note, 5-year note, 7-year note, 10-year note, 30-year bond. So that's your x-axis. And interest rates they can be negative, but kind of 0 to whatever. A normal yield curve is upward sloping. It's the longer the maturity, the higher there. And that makes perfect sense. If I'm going to lend you money overnight, I might want a certain interest rate. But if I'm going to lend you money for 10 years, I might say, hey, Brian, you got to pay me a little more because, I'm taking more risk, et cetera. Perfectly normal upward sloping yield curve. And whether it's steep or flatter, okay, that's important if you're a trader, but upward sloping. But an inverted yield curve is downward sloping. An inverted yield curve says future interest rates are going to be lower than present interest rates. Well, why would that be? If I'm lending you money for a longer period of time and I want a risk premium and protect myself, why would I take a lower rate? The answer is because I think really bad things are going to happen. And I don't mean me personally. I mean, this is the institutional market. So, and we see this in the treasury market. It flips around day to day, but right now you have an inversion in kind of 2 years to 5 years. So a 5-year note yield to maturity is lower than a 2-year note. And you see it in 7s to 10. So the 10-year note has a lower yield to maturity than the 7-year note. It's not that the whole curve's inverted, but it's in sections. It is. So at the short end of the curve, 30, 60, 90 days, 1 year, yeah, it goes up. Well, that's because the Fed controls that part of the curve. They already told us what they're doing. We know they're going to raise 75 basis points in July, at least 50 in September. We'll see what happens in November. And then they have another meeting in December. But there's no reason to think the Fed is not going to remain on this path of 50 to 75 basis point interest rate hikes for the remainder of the year, which is going to get interest rates of 4%. Now, remember when they did this from 2015 to 2018, late December 2018, they went from 0 to 2.5, 2.25, 2.5 range. Now you're talking about going from 0 to almost 4 in 9 months. That took 4 years, from 2015 to 2018. So 4 years to get 2.5. Now you're talking about 8 months or 9 months to go to 0 to 4. That's Volcker territory.
From Jim's statement, it's obvious that he is quite sure of his prediction about the imminent recession. He also took time to talk about the U.S. economy experiencing a further decline in interest rates in years to come. Recession can be caused in several ways. One of such is a sudden economic shock. A typical example of this was when OPEC stopped oil supply to the U.S. without notifying or warning them. The resulting effect of this led to a recession. Another typical example is the sudden COVID-19 pandemic that shocked economies worldwide. Recessions are also caused by a decrease in consumer spending. This can be due to a number of reasons, such as a decrease in disposable income, an increase in taxes, or a decrease in consumer confidence. Another important factor is an increase in business costs. This can be caused by an increase in the cost of raw materials, an increase in interest rates, or a decrease in demand for a company's products. Finally, recessions can also be caused by a number of external factors, such as a natural disaster or a decrease in exports. However, financial crisis, according to Investopedia, is caused majorly by some contributing factors such as regulatory absence or failures, irrepressible human or investor behavior, systemic failures, and incentives to take too much risk. Also, overvaluation of assets or institutions can also lead to a financial crisis. Some typical examples of financial crises that have occurred over the years include the British credit crisis of 1772 to 1773, the stock market crash of 1929, the Asian crisis of 1997 to 1998, and the financial crisis of 2007 to 2008. So with all this, it's quite obvious now that a financial crisis and recession are two separate entities, and the confusion of seeing them as the same should end. If you would like to know more about the coming recession, check out this next video. Thanks for watching. See you in the next video.